Centum Investments has reported a 40% drop in pre-tax profit to 1.3 billion shillings, hit by a jump in the cost of credit and currency swings. Joining us from Nairobi for a look at the numbers is the company's CEO, James Mworia. James, a 40% drop, was the market surprised by that? And what lies behind it? A tough year, presumably.
No, David, thanks a lot for that question. I actually think it was an interesting year. Yes, profits before tax came down by 40%. But when one looks at return on opening shareholder funds or return on capital, which is what is critical for us, we generated a 9% return, and in absolute terms, it was about 1.2 billion shillings. And that was in a context where the NSE came down by 13%. So we outperformed our local index by 22%. And we outperformed the majority of indexes. And that's really our objective. Our objective is to consistently outperform the market, and we achieved that objective. I think the thing to remember is that we're an investment company and we operate within a context, and our objective is to outperform the benchmark.
You mentioned a couple of things that made life difficult. Cost of credit increasing by 20%, the foreign currency market unstable, liquidity very tight. And then you said that there were 4 focus areas that you were keen to do. And they all seem very ambitious. And if you achieved them all, obviously you would have been doing well. Delivering market-beating returns while protecting shareholder value. What's behind that?
Which was critical, because we saw what was happening. We saw the market coming down. We could see the volatility, the interest rates going up. And so what we did is that we significantly reduced our exposure to listed equities. At the beginning of the year, we had about 25% of our portfolio invested in listed equities on the NSE. And by the end of the year, we had scaled that back to 12%. We also reduced our debt. We reduced that by 50%. And we increased our cash holdings from 200 million shillings to 1.5 billion shillings, which is close to $20 million. And the objective was to ensure that we at least deliver positive results in a very challenging environment, which I think is also important in terms of demonstrating management's ability to consistently deliver value, even in very challenging times. And I'm happy that we achieved at least, we measured well against all those objectives that we set out for ourselves.
You also talked about increasing value in the real estate and private equity portfolio in the short to medium term. That's by way also of saying to you, what is the balance really? You talk about real estate and private equity there, the balance of the business, the balance of the holdings.
In terms of the total asset allocation, if you look at listed equities are now down to 12% of total. The other 88% is 58% is private equity. About 2% is fixed income and cash, and the balance is real estate. And that is critical. We've been focusing on growing the unlisted and illiquid portion of our balance sheet and our portfolio, largely because we want to be in a position to consistently deliver positive returns, regardless of the fluctuations that are taking place in the market. And last year was a good year for our private equity portfolio. We recorded significant growth. We have also built a very attractive pipeline of opportunities across the region, which we expect to conclude on this year. And on real estate, we achieved significant milestones on our Two Rivers project, which we are working to make it the premier commercial destination in East Africa. We got key approvals like our change of use. The master plan was approved. We got environmental licenses. We also got licenses from the water department. And so all that is now left is finalizing the designs. And I think over the last 24 months, we've really done a lot. We've moved from 0 to acquiring almost 400 acres of prime properties in Kenya and Uganda. And we've made considerable progress in obtaining regulatory approvals, significantly de-risking the opportunity, and also getting approvals to significantly increase densities and development rights.
You mentioned Kenya and Uganda, but you also talked of geographical diversification. That could mean the whole world at one extreme. What are your ambitions with that diversification?
Our focus areas right now are East Africa, and for the rest of Africa, focusing on Anglophone countries, because those are the countries whose legal system we understand. When you look at the private equity opportunities we are likely to invest in this year, 55% of those investments are outside Kenya, within East Africa. Within real estate, about 40% of our portfolio is in Uganda. So our focus has been to grow outside Kenya and secure opportunities in other African countries, but primarily focusing on East Africa, where we have the relationships, the network, and where our brand is known, and where we understand the environment.
You say that many of the projects you've been working on over the past 24 months are about to mature. Can you share which of those projects are about to mature and what the value will be?
I think I can talk about it from 2 points of view. One is our existing portfolio. When you look at our existing portfolio, even we mentioned a few of the companies. Last month, June 30th, one of our portfolio company, Longhorn, listed its shares on the Nairobi Securities Exchange. Since the listing, the price has gone up by almost 40%, actually over 40%. The second one is UAP, where we are a 24% shareholder. 2 weeks ago, they closed about $50 million of financing from some of the leading private equity investors in the continent. And this was at a significant value uplift to what we are carrying this particular assets at. We have a couple of other assets in our portfolio whose details I cannot discuss at the moment, where we are expecting to achieve liquidity events in the coming year. The second aspect I'd like to discuss is in terms of new opportunities. We have developed a very attractive pipeline of proprietary opportunities across the region. And when I talk across the region, to be specific, that is in Kenya, Uganda, Tanzania, and Rwanda. And in terms of sectors, they're in power, ICT, manufacturing, and financial services. And in terms of quantum, is between $70 million and $100 million. And we expect to close on these opportunities this year. These are about 4 opportunities which are at a very advanced stage. And they are out of 400 or 500 opportunities that we've looked at over the last 24 months.
James, looking at the broader context that you have to operate in, we've had people on the show earlier this week and last week talking about the management of the economy, inflation, interest rates, and so on. Do you have comments on how well the authorities are managing the economy and what you might like to see in the next year or two?
I think my concern around the economy right now is we have a very high interest rate environment, which is slowing down economic growth, and that I think can be witnessed by seeing what happened to our economic growth in the 4th quarter of last year, came down to around 3.6%. Lending to consumer, to the private sector slowed down. And so generally there's been a contraction or a slowdown in economic growth. But what worries me is the significant increase in government spending in a context where the private sector growth is slowing down. And I think there needs to be a balance so that fiscal expenditure also slows down, because the public sector relies on productivity in the private sector to fund its activities. So that balance worries me. It is my hope that we will see a relaxation of interest rates soon so that the economy can resume.
Thank you there to James Mworia, who is CEO of Centum, for joining us.